Investing Rulebook by Nikhil Kamath, co-founder of Zerodha.
I think is you need to be willing to change. Whatever preconceived notion you might have come up with, you can't adhere to these notions beyond circumstances that are changing around you. The one trait I have noticed in traders who do better than others is very often the fact that they don't really have an ego when it comes to the markets. I feel like the ones who are willing to accept something is not going their way and change direction often tend to be better traders over the long run. The rule is do not leverage more than you can handle. Most people in equity markets, even retail traders, I think they burn out because of leverage. Derivatives inherently have leverage associated with them. Like, a future contract probably has 4-5 times. An option contract, depending on how far out of the money you go, it gives you many times that.
Right.
To kind of like buy these instruments only looking at how much money you need to put down versus looking at how much risk you're associating with that trade could be the biggest flaw in most trading systems or most people who are beginning their trading journey. I think it's cardinal not to use leverage beyond a point. I get it if you have a large portfolio and you're leveraging to kind of like hedge it or cover some kind of a risk. Or even if you are truly aware of what the max, how your portfolio performs in, say, a 2 standard deviation event, and as long as you're aware of all that, and then you lever is one thing. But most often people lever just to be able to get a return very, very quickly, and I think that in 9 out of 10 cases leads people to lose the principal amount. So if I had one suggestion for traders everywhere, trading, investing journeys are long. Do not try to make a return which is unreasonable at the beginning, because most often that doesn't work, especially at the very beginning, because the corpus of money was so small. I used to kind of like work in a call center at 17 and try to use the savings from there to trade. So it's not a very high paying job or whatever. And, if you're trading with sums of money such as 20,000, 50,000 rupees, you can't even buy a future contract really. There's no concept of hedging mechanism and all of that. So what you're trying to do is buy an out of money call or an out of money put or a penny stock in direction that you want to take a guess and bet the market might move in. And there have been many cycles like that where I've gone bust. I remember having a great first year, and at the end of the year there was this one trade which wiped out everything and my savings from the previous year. That probably has happened to me consistently for the first 3-4 years of my trading journey, where I would save from a job, invest, grow it, become a little bit stupid and egoistic about it because you're jaded by your own track record in a way. If you have 4 consecutive successful trades, innately you want to take a larger trade when the 5th time comes around. I think the human subconscious works like that.
Right.
So I've had a sequence of that. Maybe the first few years of trading were totally that. As you kind of evolve as a trader, you tend to realize that even if it works for you in the short term, a strategy where you're betting all your chips every time you get a hand cannot work in the long term. And the key in stock markets is that whatever strategy you have to figure out a way in which it's sustainable, not for the next 1 year or 2 years, but for your lifetime. And when you start to factor in risks in that manner, I think the key is to not look at money as money and look at it as the day you start to equate the money you're making and losing in equity markets with things you can do outside of the market, like if X profitable trades equal to a smartphone or a house or a car or whatever, it becomes very hard to kind of strip away emotion from that equation. I think you have to look at stock markets in isolation and vacuum. You try and achieve a return which is reasonable. In India, let's say the risk-free rates are 5% or 6%. I feel like if you can make between 12 to 15% a year is an incredible return. At 12%, you double your money every 6 years. And I think you have to kind of like re-establish your target rate of return at something like that. You can't go into equity markets and hope to make 50-100% because that just isn't logical. If anybody could do that, they would have done incredibly well, but doesn't happen. The second thing is, I think outside of having reasonable expectations, when you kind of plan for a 30-year time period where you will be active and investing and trading, things tend to have your risk parameters change and you kind of become more reasonable in how you allocate.
Investing in financial markets can be a daunting task, as it involves allocating capital with the aim of generating returns. One key element that distinguishes successful investors from others is their ability to harness the power of leverage and maintain emotional discipline. Leverage, when used wisely, amplifies investment returns and enhances wealth creation. However, it is essential to separate emotions from investment decisions to make rational choices and avoid detrimental mistakes. Leverage, in the context of investing, refers to the use of borrowed funds or financial instruments to amplify potential returns. It allows investors to control a larger position in the market than the capital they actually possess. Leverage is commonly used in various investment vehicles such as margin trading, options, futures contracts, and exchange-traded funds, ETFs. By employing leverage, investors can magnify both gains and losses, thereby increasing the potential for higher profits or, conversely, greater risks. The primary advantage of leverage lies in its ability to enhance investment returns. For instance, if an investor purchases $10,000 worth of stocks using 2-to-1 leverage, their total exposure in the market becomes $20,000. If the stock appreciates by 10%, the investor's gain would be $2,000 instead of $1,000, without leverage. Leverage enables individuals to participate in larger market movements and potentially generate substantial profits. While leverage presents opportunities for significant gains, it should be approached with caution. Prudent investors employ strategies to mitigate risks and maximize potential returns. Here are a few key strategies to consider. Risk management. Adequate risk management is crucial when utilizing leverage. Investors should carefully assess their risk tolerance, set stop-loss orders, and diversify their investments. By spreading their exposure across different asset classes, investors can minimize the impact of potential losses on their overall portfolio. Fundamental analysis. Before employing leverage, investors must conduct thorough fundamental analysis. This involves assessing the financial health, competitive position, and growth prospects of the investment instrument. A solid understanding of the underlying asset helps investors make informed decisions, reducing the likelihood of making emotionally driven choices. Technical analysis. Leveraging technical analysis techniques can help investors identify optimal entry and exit points. By studying historical price patterns, trends, and market indicators, investors can make more precise predictions about future price movements. This analytical approach provides a logical framework that supersedes emotional impulses. Controlled leverage. While leverage can enhance returns, excessive borrowing can lead to substantial losses. Wise investors use leverage sparingly and judiciously, selecting instruments and levels of exposure that align with their risk appetite and investment goals. This cautious approach reduces the impact of potential downturns and preserves capital. Emotions can cloud judgment and lead to irrational decision-making. To be successful in investing, it is crucial to detach emotions from investment choices. Here's why emotional discipline is vital. Avoiding herd mentality. Emotions often drive investors to follow the herd, resulting in buying during market euphoria and panic selling during downturns. Succumbing to the fear of missing out, FOMO, or the fear of losing out, FOLO, can lead to poor investment outcomes. Rational investors understand the importance of independent thinking and maintain a long-term perspective. Overcoming cognitive biases. Cognitive biases, such as confirmation bias and recency bias, can distort perceptions and hinder rational decision-making. Confirmation bias leads individuals to seek information that confirms their pre-existing beliefs, while recency bias causes investors to overweight recent events. By recognizing these biases and actively challenging them, investors can make more objective assessments. Patience and discipline. Successful investing requires patience and discipline. Emotional investors often succumb to impulsive decisions, driven by short-term market fluctuations or sensationalized news. Rational investors understand the importance of sticking to their investment plan, regardless of short-term market noise, and are willing to hold investments for the long haul. Objectivity and risk assessment. Emotional investors tend to underestimate or overestimate risks based on their current emotional state. Rational investors approach risk assessment objectively, evaluating potential risks and rewards based on fundamental analysis and a clear understanding of the investment thesis. They make decisions based on logic and research rather than emotions. Leverage can significantly amplify investment returns but should be approached with caution and discipline. Rational investing requires separating emotions from investment decisions, as emotional biases can lead to poor outcomes. By employing strategies like risk management, fundamental and technical analysis, and controlled leverage, investors can harness the power of leverage while mitigating risks. Maintaining emotional discipline involves avoiding herd mentality, overcoming cognitive biases, exercising patience, and making objective risk assessments. Mastering these skills is essential for achieving long-term investment success and wealth creation. Investors who recognize the importance of leverage and maintain emotional discipline are better equipped to navigate the complexities of the financial markets, capitalize on opportunities, and achieve their investment objectives.